All right, so OCBC's latest results are out, and honestly, they tell a fascinating story. It's like a financial tug-of-war. The headline profit number looks pretty stable, but that's hiding a huge shift happening just underneath the surface. So let's break down what's really going on with one of Asia's biggest banks.
So here it is, the big number, $1.98 billion in net profit for the quarter. I mean, on the surface, that looks rock solid, right? It's almost exactly the same as last year. But you really can't let that stability fool you, because beneath this calm surface, there are two powerful currents pulling the bank in completely opposite directions.
And this tells the whole story. It's really a tale of two different incomes. On one side, you have the bank's bread and butter, lending money, the thing we all think banks do, and the income from that, it's down 9%. But then you look at the other side, the money from fees and trading, and boom, it surged an incredible 15%. This is that tug-of-war in action. The bank's old, reliable engine is sputtering a bit, while this new, more powerful one is just roaring to life.
Okay, let's break this down, and we'll start with the tough part. Section 1, the squeeze on lending. We're going to dig into exactly why the bank's main business is feeling the heat right now.
So to really get this squeeze, there's one key term you got to know: net interest margin, or as you'll hear it called, NIM. The simplest way to think about it is that it's the bank's profit margin on its main job of lending money. It's the gap between the interest they earn from loans and the interest they have to pay out to savers like us. The wider that gap, the more profitable the bank is.
Now just look at this trend. This chart shows what's happened to OCBC's NIM over the last year. And wow, that downward slope is impossible to miss. It's dropped from a really healthy 2.18% all the way down to 1.84%. This is exactly what people in banking call NIM compression, and it's a perfect picture of that profit squeeze we were just talking about.
So why is this happening? Well, it all comes down to the bigger economy. We're in what's called a softening interest rate environment. In plain English, that means the interest rates OCBC can charge on new loans are dropping faster than the rates they're paying people for their savings. That shrinking gap is what's putting the squeeze on their lending profits.
But okay, while that lending engine is under all this pressure, another part of the bank is just exploding. So let's flip the script and move to Section 2 and see how OCBC's huge bet on wealth management is paying off in a spectacular way.
Check out this number, because this is what's saving the day. A staggering 53% jump in wealth management fees compared to this time last year. This isn't just a little bit of growth, it's an all-time record for the bank. This is that powerful counterforce that's pushing back against the lending squeeze.
And look how central this has become to the whole operation. This quarter, wealth management made up 43%, almost half of the entire group's income. This isn't a side business anymore, not by a long shot. It's now a main pillar of the bank, and it tells you everything about where OCBC sees its future growth.
So where's all this record income coming from? Well, it's being fueled by a massive influx of money from clients. The bank's assets under management, or AUM, have just soared to a record $336 billion. And the logic is simple, right? The more money you manage for clients, the more fees you generate. But the real question is, what's driving this incredible flow of cash?
It really seems to be a perfect storm of good things all happening at once. First, their existing clients are just being more active. Second, and this is a huge deal, they're getting tons of net new money flowing in. You have to remember, there is incredible wealth creation happening across Asia, and a lot of that capital is looking for a safe, sophisticated place to call home, like Singapore. Add to that a great quarter from their trading desks and a strong performance from their insurance arm, and you've got a picture of success across the board.
So we've got this fascinating push and pull dynamic going on. But here's the thing. For a bank to successfully pull off a major strategic pivot like this, it needs to be built on an absolutely solid foundation. So let's move to Section 3 and look at the bedrock that's supporting OCBC through all this change.
This number, 0.9%, might not look very exciting, but in the world of banking, it's beautiful. This is their non-performing loan ratio, which is basically the percentage of their loans that have gone bad. The fact that it's not only super low, but has been stable for 6 quarters in a row, that signals that the bank has been incredibly smart and disciplined about who it lends money to.
So what this really means is that the bank's loan book is just incredibly sound. But it's not just about playing defense and avoiding losses. Having a strong foundation like this is what gives you the stability to handle shocks, and even more importantly, it gives you the confidence to play offense, to pour resources into those high-growth areas like wealth management. It's the discipline that enables the dynamism.
And here's one more piece of that financial muscle, the CET1 capital ratio. At 15.0%, it's way above what regulators require. You can think of it as the bank's financial safety cushion. If a crisis hits, this is their shock absorber. And right now, that cushion is very thick. This is the firepower that lets them be bold.
Okay, so we've got a complex present, a clear strategic shift, and a really strong foundation. The big question now is, what happens next? Let's get into our final section and take a look at how the bank's own leadership is seeing the road ahead.
You know, the group CEO, Helen Wong, really summed it up perfectly. She celebrated the strong set of results and pointed to the resilience of their diverse business. But she was also very clear-eyed about the future, noting the complex external environment, which is basically CEO speak for things could get messy. And she pointed right back to that strong balance sheet as their key to managing whatever risks come their way.
And this slide really captures the tightrope they're walking. On one side, you have some serious risks: global volatility, geopolitical tensions, a potential economic slowdown. But on the other side, the opportunities are just massive. Think about financing the rebuilding of regional supply chains, funding the huge energy transition, or capitalizing on the nonstop march of digitalization. They're right in the middle of all of it.
So what can we watch for? Well, the bank has given us some pretty clear targets. They expect that net interest margin to stabilize around the 1.90% mark. They're aiming for modest loan growth in the mid-single digits. And, this is a big one for shareholders, they're sticking to a generous 60% dividend payout ratio. These are the key numbers to track going forward.
So after everything, we're right back where we started, that financial tug-of-war. The old engine of lending is getting squeezed by the economy, while the new engine of wealth management is surging. The ultimate question is, as we head into a more volatile future, is that new engine powerful enough to pull the entire bank forward? For OCBC, that really is the billion-dollar question.